Let's forecast the income statement for next 5 years. For the revenue, I'm going to say equals to previous revenue into bracket open 1 plus. I'm going to add the revenue forecasted for next 5 years percentage and close the bracket and press enter, right? For the cost of goods sold, basically the cost of goods sold we have calculated in a percentage of revenue for last 5 years. So I'm going to say revenue into percentage that we have calculated for last 5 years. It is pretty consistent about of around 62%. So I'm going to say this, right? Now the gross profit is revenue minus cost of goods sold, and I'm going to control R. Similarly, for the salary, I'm going to say revenue into percentage of salary. That would be 18%. And we're going to follow the same rule for the rent and expenses. Revenue into the percentage of rent and overheads, right? For the depreciation and interest, right? We need workings for that. We'll have to get the depreciation from the PPE account, right? Depreciation schedule. And for the interest, we need to calculate the for the interest we need to calculate the debt schedule. Once we are done with the debt schedule, the numbers directly come from the debt schedule for the interest and depreciation schedule for the depreciation and amortization. So in the meanwhile, I'm going to say sum of these four. These are expenses, and earnings before tax is gross profit minus total expenses, and I'm gonna control R here as well. I'm gonna say control R, right? Taxes are before earnings into percentage of tax. That would be this, right? And earnings before tax minus taxes. This is net earnings, and I'm gonna copy and paste.